hopefully you can hear me and see me. Thanks for joining the webinar. Today we're going to be talking about capital allowances and sort of maximising the benefits. I'm Gurj Sandhu. I'm a partner in our Birmingham office and I'm our National Head of Capital Allowances. So in terms of today, next slide please, what we'll cover, there's a fair bit there. We're not going to go into anything too technical. It's very much sort of looking at the key opportunities, some of the hot topics, and going over a couple of case studies. So a fair bit to go through, but like I say, nothing too technical. Before we kick off, just a couple of housekeeping points. The session will last about 45 minutes to an hour. There is some time for Q&A at the end, so please do send some questions through on the message chat and box. We'll collate those and we'll run through those at the end of the actual presentation. If for any reason you have to leave early or we don't get round to your question, our contact details are within the slides, so feel free to send us any sort of questions or queries or follow-ups. We'll be more than happy to sort of help and address those. A copy of the slides will be shared with you after the presentation as well. So if we move on to the next slide. In terms of today, it will be myself. As I say, I'm a partner in the Birmingham office and National Head of Capital Allowances, and Rebecca Spain. Before I pass over to Rebecca to introduce herself, just a quick note on the team. We are a national team. We cover sort of projects from the very north of Scotland down to sort of the Midlands and down to, well, the very south to Cornwall, London, southeast. So we will cover the majority of the UK in terms of our ability to provide capital allowances services. We are a multidisciplinary team. So I am a chartered surveyor as well as a chartered accountant. We've got a mix throughout the team, which ultimately helps us become what I would say is real specialists in the area and sort of our ability to really maximise and optimise sort of the tax reliefs available. So over to Rebecca to introduce herself and kick off the presentation.
Thanks, Gurj. So my name's Rebecca Spain and I'm a chartered accountant and chartered tax advisor. I've specialised in capital allowances for, it'll be 10 years this September. Okay, so for the next 5 minutes or so, I'm just going to run through the basic technical outline of the relief, just so you can leave this webinar, hopefully, feeling more confident in your knowledge. Throughout the next half hour or so, I think there's going to be about 4 polls where you can vote your answers, and this is just to help us gauge where to focus our attention on. With that being said, we're going to start with the first poll, which will hopefully pop up on your screen any moment. Okay, so are you already familiar with capital allowances tax relief? I'm just going to give you 20 seconds to quickly submit your vote. It's nice and easy, just a yes or a no, and it really doesn't matter which answer applies to you. I'm hoping we have a nice split of answers because I know there's a real range of attendance here today. So if we can, hopefully that's long enough for most of you to have voted. If we can bring up the results. Moment of truth. Ah, brilliant. Okay, a lot more yeses, which is great news. I'm really pleasantly surprised with that, actually, because you would be surprised how many people have never heard of this tax relief before. So we've obviously got a very clued up audience, which is good. So if we touch on the basic outline of the relief, to sort of set the scene, accounting profit, so a profit that's in your accounts or the books, is different to taxable profits. We have to make certain adjustments from our accounting profit to get to our taxable profit. And one of those adjustments is to add back depreciation, but in its place, you get a relief called capital allowances. So you often hear people say that capital allowances are a tax deductible expense, that they reduce a business's taxable profit. So by lowering the taxable profit, you're lowering your tax bill. Within capital allowances, there are different rates of relief. Some are really generous and some are a bit slower to attract the relief. We often call or separate these into what we refer to as pools, and different assets sit within the different pools. At the bottom of this slide, there's a couple of 4 or 5 bullet points, and these are just examples of some of the pools. They're the more common examples. So the first one there is plant and machinery. And within the plant and machinery, we have a main pool and a special rate pool. So the main pool attracts relief at 18% a year and special rates at 6%. So just to give you just really quickly an idea of some assets that would sit in the main pool, that's your kind of fixtures and fittings, desk, chairs, computer, sanitary ware, fire alarm, security, carpet, and then assets that sit in the special rate pool are assets that are integral features to the building. It's your sort of mechanical and electrical systems, lighting, power, mains, sub-mains, and your waters. The second point there, structures and buildings allowances. That's a less generous relief. That's only 3% a year. That being said, though, prior to the end of 2018, you didn't get any tax relief on structures and buildings. So really, we shouldn't complain. And it's within the name, but the assets that would include are things like your walls, your floors, your ceilings and doors. The third one, super allowances. Now, these are the most generous. They attract relief at 130% or 50%, but I'm going to cover them in more detail on my last slide. The second to last one, research and development allowances, that's 100% relief. And conscious, I don't want to get too technical. It's more just to give you an idea that there are different types of reliefs within capital allowances, but we do also have the annual investment allowance, which is on there, and that's 100%. Another relief that's actually not on there, but Gurj is covering in about 10 minutes, is land remediation relief. So he can tell you all about that one. It's probably worth at this point just mentioning that this capital allowances relief, it is really flexible. It's a generous scheme, and because of that, it sometimes companies that have taxable profits, once you deduct the capital allowances, if your claim is so big, it can actually bring taxable profits into a loss, which means no tax is paid that year. Any extra loss can also then be carried forward or utilised in another way. So it's not just important for the really hugely profitable businesses. So I think it's time for our second poll, which hopefully will pop up. Okay, so has your business submitted a capital allowance claim in the past 12 months? Again, I'll just give you 20 seconds to quickly submit your answer. And don't worry if your answer is you don't know. Capital allowances really is a niche area that so many people aren't aware of it. I was actually really surprised with the first poll how many people said that they were aware of it. Okay, so if we pull up the results of what that's brought in. Oh, brilliant. Okay, so quite high yes again. That's really good. And there, I think we've got sort of 300 attendees on, so that's a really healthy number of claims made in the last 12 months. I'd be really interested actually to know how many of those claims were done sort of internally or with a specialist, and how many Azets have done. Okay, so I think next I'm handing you back to Gurj, who's just going to talk about the sectors we cover and then go over two of the main areas of spend we tend to review.
Thanks, Rebecca. Yeah, so I've put this slide in fairly early because I do often sort of get sort of questions from people around, well, capital allowances only relate to sort of property investors, and that's not strictly true. There's many owner-occupier sort of businesses out there across most sectors that can take advantage of capital allowances. What we tend to find is that we're attracted in terms of the work that we do to businesses or sectors that have a relatively heavy commercial property portfolio and where costs are being incurred on that portfolio on a regular basis. So I have a number of sort of care home clients that are either acquiring or refurbishing, maintaining their portfolio of homes on a regular basis. to sort of the leisure and hospitality, so where you've got restaurants and pubs and bars, where again they may have a portfolio of sites that they continually sort of spend or incur sort of capex on, to sort of car dealerships. But that's not to say if you are a business that carry out a certain service, we carry out sort of reviews of head office sort of refurb spends and one-off projects as well. So a real array, and I just wanted to flag that we work across most sectors, so that shouldn't limit, say, the opportunities around capital allowances, I would say. So if we move on to the next slide, so as Rebecca said, there's two key opportunities that I want to talk about. The first being property capex projects. So this is really where businesses are incurring capital expenditure in respect to their sort of property portfolios. And that expenditure can be in the form of new developments, new construction projects, to the refurbishment or the fit out of existing. So what I would say, this is really our bread and butter type of capital allowances report and claim. Most of these types of projects will incur a significant amount of capital allowances tax relief, anywhere from sort of 30 to 90%, depending on the profile, the business, the nature of work that's being carried out. In terms of what we do, it's very much getting involved in our aspect as early as possible, so we can sort of understand exactly what is going to be done as part of the project. We will look to facilitate and collate the relevant information. If that's not available, that's not a problem. As I've mentioned, we are a sort of multidisciplinary team. We can go out on site and carry out a survey if information is limited. That allows us to sort of identify the qualifying assets to really sort of optimise and maximise some of the relief that's available. And it's often only until you do a survey that you can appreciate exactly what work has been carried out and the purpose behind that. And that helps to sort of increase the position. And sort of encompassing all of that work is a final report that we tend to produce. That is submitted to the client and to the HMRC with any claim that's made within a tax return. And the key there is to really have a report that is robust and supports the claims that are being made. We often find HMRC might inquire into a claim where it seems a little bit out of norm for the business, and without any supporting documentation. So hopefully our report and analysis will give not only the client but HMRC comfort that the appropriate claims have been made. Next slide, please. So in terms of property acquisitions, again, I tend to sort of have conversations with clients that are very hot on the topic of acquisitions, and they know exactly the right questions to ask in terms of when they're acquiring property. But equally, a number of businesses or individuals or groups that aren't quite aware that actually a proportion of the purchase price incurred on a property acquisition may qualify for capital allowances. And that's that around where we would carry out a valuation to unlock the qualifying element. That's sort of, I guess, a proportion of that purchase price. And typically, if the fact pattern works and there is entitlement to make a claim, then we can sort of see anywhere from sort of 6 to 30 up to 30% of the purchase price actually qualifying for tax relief. And that's not an insignificant amount. So there is considerable sort of merit in looking at your property purchases and understanding whether a claim can be made. And the rules around whether claims can be made or not had changed in 2014. So as part of our role in supporting clients is very much looking at the property history, the entitlement of whether a claim can be made, and we would advise from that front. The second element, as a result of the changes in the legislation, has been the increased need for Section 198 elections that need to be agreed. This is between the seller of a property and the buyer. Again, what we find is some people very good and know exactly what an election is and why it's required. Some are completely unaware. And where I advise clients, we tend to find that's where we get the sort of optimum position where we are able to ensure that either allowances are retained or transferred, depending on the scenario of the transaction. Next slide, please. So the next poll, if we can move on to that, is around: have you recently or historically incurred expenditure on property, either to sort of occupy or let? I'll give another sort of 15-20 seconds for you to answer. And this will be interesting because, again, probably one of the biggest or the most frequent questions I often get around capital allowances is around how long do we have to claim? And actually, as long as you still own the property, the assets that we potentially could make a claim on are still present, and you're using the property, either as to rent out or part of your business. We can go as far back as we like. Ultimately, there is a nuance around the sort of 2-year tax compliance window. So there's certain accelerated reliefs that we may not be able to utilise, or we would be restricted. But in terms of main pool, special rate, and allowances, plant and machinery allowances, we can go back a significant period of time. So even if you have incurred expenditure or acquired property, and historically there's still potentially a chance to revisit that spend and look to identify some allowances in relation to it. If we go to the results, sorry if I'd be interested to see. So okay, it's sort of evening out a little bit. It's hopefully, in terms of those yeses, those 58%, if there's a case where you would like to pick up, and we can have understand exactly what the opportunity is, that's something that we can do. If there's anything actually throughout this webinar that you have questions around and we don't get a chance to sort of look at it or cover in the Q&A, feel free to sort of contact your local sort of Azets contact, or like I say, our contact details will be within the sort of slides that are shared, so feel free to reach out to us. If we could move on as well. So I'll hand over to Rebecca to run through a couple of case studies.
Thank you. So just to give you an idea of how capital allowances can help businesses in the real world, I'm just going to run over 2 client examples we've recently worked on. And in line with the 2 slides Gurj went over, where we had an acquisition and a fit out, I'll do the same here with the case studies. So just looking at an acquisition firstly, this was a client of ours. He's a UK real estate investor, and he bought an office for 950k from a pension fund. The pension fund had owned it since it was constructed in, I think it was 2001. Because it was acquired from a pension fund, and pension funds don't pay tax, we knew that no capital allowances would have been historically claimed on that building, because prior to the pension fund, it was newly constructed, so they were the first owner. So we know all the way back from the beginning, no capital allowances had been claimed. And therefore, we could do what we call an unrestricted claim on the acquisition. So with acquisitions, the client or the business doesn't have any of the cost detail, like the breakdown of the assets, because they didn't build it. They just know what they paid for the land and the building as a whole. So all we tend to get information wise on acquisition claims is just the purchase contract, which states the total sum they've paid. So in order for us to price out those qualifying assets and put the correct assets into the relevant pools, what we have to do is reconstruct that building and its components. And usually to do this, we go out onto site and we do a site survey of the whole building and the external area. Then we come back and we reconstruct the build cost to identify that proportion of qualifying assets. Now, in this example, we identified 170k of qualifying assets out of the 950k purchase price. And what this sort of results in, or what this means, is that it's a cash tax saving of 32k, because the 170k of qualifying assets we identified, which we deduct from their profits, he's a limited company, so 19% of the corporation tax rate at that 170k is a tax saving of 32k, and that's all given in year 1. Okay, so the next example is a fit out example. So this is how Gurj was saying, it's kind of the bread and butter of what we do. And in this instance, this client was a convenience store, and they had multiple sites. They had actually never engaged in a capital allowances specialist before. I don't think they were highly profitable beforehand, so they didn't see initially the benefit, but as they started to become profit making, they got in touch. And as Gurj mentioned just a minute ago, there's no time limit to which capital allowances have to be made. So we decided to look back at the past 5 years of CapEx relating to leasehold improvements, which totaled around 5 million. They tend to spend about 1 million a year on their portfolio. But just to mention, this is one of our larger clients. We thought we'd show off a bit and do some of our biggest clients, but that's not to say much smaller spend is still worth reviewing, and they're just as worthy. But anyway, going back to this example, that 5 million of capital spend was previously just sat in non-qualifying, attracting no relief at all. And through our sort of detailed analysis, we identified qualifying expenditure of 1.2 million, as well as capitalised revenue expenditure of 1.9 million. And that's expenditure that isn't necessarily capital improvements, but it's more repair work. Being a convenience store, they have like a high footfall. They're constantly having to do repair work, such as replacing the flooring, like painting and decorating, general wear and tear. So with that qualifying expenditure of 1.2 identified and the capitalised revenue of 1.9 identified, it resulted in a cash tax saving of around 650k, which was really huge for them, of which 100k was actually realised in that first year. I don't know if there's anything you want to add before I jump onto the next technical point, Gurj.
Yeah, there's just a couple of points that I think you mentioned. So the first one is, I guess, the size of an opportunity, and yes, we've shown a couple of sort of examples where I would say they range from to quite a large amount of capex that's been incurred. But equally, we do a number of projects where maybe somewhere between sort of 250k to 500k of expenditures being incurred on something like a furnished holiday let. The individual is a higher rate taxpayer, so the actual savings that are that could potentially be able to be unlocked or realised are quite significant. So depending on the project, depending on the taxpayer, whether income, higher rate or a corporate, I wouldn't say we just focus on large sort of capex reviews. We will work across the board really of a portfolio of different sort of opportunities. So not something, even if you think, oh, this opportunity might be a bit small, again, feel free to sort of get in touch or speak to your sort of local contact about whether it's worthwhile to make a claim. The second point as well was around the leasehold improvements. So again, sometimes there's confusion as to is it only the freeholder that can make a claim for capital allowances? That's not the case. If you are a tenant and you are incurring leasehold improvement costs, you have an interest in the land, you have an existing lease with the landlord, then that expenditure is all within scope. So there definitely is an opportunity there, and it's definitely a worthwhile exercise to have a look at that as well. Thanks, Rebecca. Back to you.
Thanks. One other thing I just thought of worth saying as well, regardless of the size of the spend, it's always our mission to sort of make your life as easy as possible. So we don't need hardly any input from you at all, as long as we know, say with acquisitions, what you bought it for. We can do all the rest. And same with the fit outs and refurbs. We quite often do site surveys, and through doing that, it really reduces the amount of questions we'll have to ask. So we appreciate you're busy with your day-to-day jobs, but it is something that we can just run with, and yeah, should have very little involvement from the actual client. The last topic I'm going to touch on before Gurj finishes off is all around the super allowances. This might be our last poll. I can't remember if there's one or two left, but if we just pull up the next one. Okay, are you planning to invest in new assets over the next 12 months? And again, we'll just give you 20 seconds to quickly answer that one. I'd be really interested to know how different the split would be if the government didn't release these new super allowances, which I'm going to go into. If all being well and they've achieved what they wanted to, hopefully it's going to result in a lot of yeses, because I'd like to think it's encouraged capital investment, but let's take a look at the answers. Yeah, okay, that's good. More yeses, 71%. That's a really positive response, actually. And hopefully these new super allowances I'm going to talk about are going to provide a really healthy boost to the business. So the relief you'll be able to claim is going to be much higher these next 12 months as it has been in the past, and how it's going to be in the future. So I'm going to talk you through these super allowances. Okay, to set the scene, you might be thinking, so why do we have these new super allowances? Why are they being so generous? In Rishi Sunak's words, he introduced this as, and I'm sure this was word for word, as a direct way to help businesses invest and to drive growth in the economy following the COVID pandemic. Okay, so what are they? The super allowances, it's enhanced relief for expenditure incurred in a 2-year time period. So it's just between the 1st of April 21 and the 31st of March 2023. On one of the first slides, when I was talking about the different pools and the rates of allowances, the first one on that bullet point was plant and machinery allowances. And these super allowances is what sort of replaced that plant and machinery allowances. Before, we had the main pool, which were the assets with the fixtures and fittings, the sanitary ware, your fire alarm, that kind of thing. Previous to this 2-year enhanced relief, they attracted 18% relief every year, but now they're actually going to attract 130%. And as for the special rate assets, so that was your lighting, your power, hot and cold water, that was only at 6% a year. Well, now in this 2-year time period, it's actually going to attract relief at 50% a year. So you can claim back all that cost just within 2 years. And there's no cap at all on the amount of spend, which is really good for some of the big businesses out there. There are a few drawbacks. One of the main ones, which really surprised me, and I thought they were going to go back and change it, is that this doesn't apply to sole traders or partnerships. It's for companies only, which is a little bit of a shame. But at least sole traders and partnerships can get what the annual investment allowance, which we've not touched on too much, but that is a 100% relief, but it is capped at $1 million. The other point to note is it's not available for contracts that are entered into before that key date of the 3rd of March 21. And the important point is contracts entered into. It's so even if, say, in February you agreed with a company X Limited to come in and do some work, even if they weren't carrying out that work for 2 or 3 months because there was a wait list for materials or they had other clients, it doesn't matter that the spend was incurred in that 2 limit. It's all about when the contracts were entered into. So I do have a couple of clients that missed out on that enhanced relief literally by a few weeks. The only other drawback or exclusion I want to just mention is that it isn't available for second-hand assets, and this therefore rules out second-hand property purchases. Gurj, is there anything else you wanted to touch on with the super allowances?
No, I think for the purposes of today, that's a really good outline. Again, it's just that sort of that final sort of grey box there. Some of the rules can get complex and the scenarios can get complex, so please do just raise your queries or questions if you're not sure whether the super deduction will be sort of within play or not with your local sort of advisor, or feel free to get in touch with us if you've got any queries. Like I say, it is very attractive in terms of the relief that's available, so it's worthwhile sort of having a think whether your assets or the expenditure you're incurring would qualify.
Yeah. So I think just for the last 5 or 10 minutes, it's back to you, and you've just got 2 more areas I think we're touching on before any Q&A.
Cool. Thanks, Rebecca. So yeah, land remediation relief. So not strictly a capital allowance, but works in a very similar way. We as a team are specialists within this area as well. It was sort of introduced as a government initiative to help encourage the remediation of contaminated land, buildings, derelict land. It's very much there to help encourage and restore some of those sort of brownfield sites that we see across the country and the UK. The tax relief is generous, 150% for owner occupiers, and that's where costs are capitalised, or 50% for a developer, a property developer, where the cost may be more revenue in nature. And unlike capital allowances, if you are loss making, there's actually the opportunity to claim a tax credit, which can be quite attractive depending on the level or the scale of contamination, the work that's needed. Your typical sort of contaminants there in that next bullet point, I'm not going to read them off, but I guess the key is hazard. So are the contaminants causing sort of hazard to the human health now or potentially in the future? And is it of a significant nature? So the tax legislation is quite complex in the area, and there are a number of rules that you almost have to sort of jump through in order to make a claim, and that's our role. So that's effectively what we do in terms of these types of projects. So for example, I have a number of sort of property developer clients that will acquire some brownfield site, it will need some remediation, and they will then go, once that remediation has occurred, they'll go and build a housing estate or a number of units on that sort of land. Those claims can be substantial because of the level of contamination could be quite significant. Equally, we carry out smaller reviews as part of a wider capital allowances review, where a client may have bought an old manufacturing warehouse. There might be some asbestos in the roof, and they've gone and treated that asbestos. So we'll cover it off across sort of a broad range of projects. Again, yeah, derelict land as well. There's some rules, quite specific rules around whether the expenditure sort of incurred on treating derelict land or developing derelict land qualify. So again, that's something that we would look at. Unlike capital allowances, land remediation relief is subject to corporation tax only. So any sort of sole traders or income tax payers are unfortunately excluded. Partnerships, there's a slight quirk. So if there is a corporate member as part of a partnership, then that corporate member may make a claim in respect of its share of the partnership and the expenditure that's been incurred. So a couple of things to note if you think you potentially might be able to make a claim. And if we move on to the next slide, so trigger points, and this is sort of coming up to my last slide now, and it's a bit of a summary as to what we've covered. And it's around sort of some of the things that maybe you will see and might trigger you into thinking, oh, actually there might be a claim here for me to look at, in terms of, you know, whether it's worthwhile getting a specialist involved to really maximise that sort of tax relief position. Just to sort of recap, there's no time limit in terms of capital allowances. So as long as you still own the property, the assets are still present, we can revisit historical spend. The tax relief then is brought into the next sort of open tax return, and that, depending on the profile of the business, so we do have that 2-year window. If you've sort of paid tax in the prior year, if a claim is brought in, then there is sometimes the opportunity to get a cash repayment back from HMRC, and I see that on a number of occasions with clients where we carry out historical reviews, and sort of just following on from that, historical detail or just generally cost details, if there isn't much in terms of information available, that's not a problem. We can go out on site, we can do surveys, we use builders price books to carry out various calculations to ensure we quantify the qualifying assets as appropriate. And typical projects, so just to recap, you know, property acquisitions, the new builds, sort of constructions, any refurbishment, fit outs, extensions to existing premises. They're all the sort of typical types of projects that we would get involved in. And one of the things that we often do is a sense check of any existing claims, and this sort of ties back to that historical review. So we're more than happy to do a sort of a health check, free of charge, of historical spend, with a bit of information, maybe a review of the tax returns and an idea of the types of projects and the capex incurred. We could potentially come back to you whether there's an opportunity there for you. And again, just going back to, I think Rebecca mentioned this a few slides ago about sort of being involved, upfront advice. So there's the element of liaising directly with contractors, quantity surveyors, project managers. We can do the heavy lifting if that's what you would like. We can build those relationships, ensure that we get as much information as possible. And to transactions as well. So, we can talk with your lawyers around what needs to be done around a 198 election, and how can we maximise the position from a property purchase point of view as well. And I guess the point there actually to think about is around a question, again, often get asked around, when should we get involved? When should we introduce you to our contractors, our lawyers? My answer would be really simple: as early as possible. As soon as we know or understand exactly what is going to happen, whether that's a purchase or a significant refurb, we can go out and collate as much information as possible so that we have that to prepare a claim, or we can advise, like I say, on a transaction to as early as possible to ensure you get the most of the benefit or the optimum position from an election point of view. And then the final point there is very much just on remediation. As I say, the team, we are specialists in this area. So if you are incurring costs on asbestos, Japanese knotweed, various sort of hazardous contaminations, then there could be a significant claim there as well. And so it's just one to watch out for. So in terms of the presentation, in terms of the topics we wanted to cover, that is very much it. Appreciate it's a bit of a whistle stop. There's lots that we've covered. There's lots to talk about with the recent incentives, the super deductions. And so, yeah, if there are any further questions that we don't get to cover, feel free to get in touch. So let me just pick out some questions now.
There's been quite a lot, so I don't think we'll be able to cover them all.
So the first one I've got, actually, Rebecca, which is an interesting one, given sort of where we are with climate change. Given we are now in a climate emergency, what can be done for companies, partnerships, organisations to encourage renewable power generation, asset investment? I'll sort of probably take that one. Historically, we did have enhanced capital allowances, and that was a incentive that the government had brought in to encourage businesses to use green technology. And the incentive there were to accelerate certain reliefs and to have certain tax credits that are available if the business was in a loss-making position. Unfortunately, the government have phased out that relief, and so as it stands from a capital allowances point of view, there aren't any sort of incentives at the moment to invest in green technology or green assets or energy efficient sort of assets. Hopefully that will change. We'll wait to see. I guess the aspect is that we have the super deduction, so there are sort of certain enhanced reliefs there if businesses were to invest in energy efficient assets, but we have to wait and see. So next question: if we have Azets calculate our corporation tax, do they automatically take these allowances into account? Good question. From my perspective, we tend to get involved as a specialist team when there is a significant sort of property project. So where a property has been acquired, where a property is going to be refurbished, where you have your typical sort of annual capex, that might be on some furniture, some laptops, some computer equipment, motor vehicles. That's where I would say the Azets sort of tax compliance or accounts teams will be comfortable in making claims. We would really be sort of involved where there's something a bit more significant, and that's where we talk about sort of going out on site and carrying out surveys and and preparing sort of specialist reports. And what we find is, yes, there is an added cost to that work, but the ultimate benefit and the tax savings and the enhanced tax savings that are ultimately identified will, in most cases, pay for the work that we would do. So
yeah, if the spend is really clear cut and obvious, so it's just a new van for the business or a new piece of machinery for the factory, and that's just one item and it's stated really obviously, the Azets corporation tax team will make sure they'll claim on that. But if it's more complicated and there's maybe not a good breakdown, that's when we would need to be involved and go out onto site and sort of break it down ourselves.
Next question. So, can capital allowances be split between landlord and tenant, providing they're not claiming the same allowances? I don't know, if Rebecca, if you want to have a...
Yeah, they can definitely. So the person who can claim the allowances is the person who's incurred the expenditure. So if what we tend to see is the landlord might do more of the background work. So they often maybe do the emergency lighting. If there's communal areas to a building, like in the core, such as the lifts, the stairwells, and then the tenant tend to fit it out to their specification. So that might be the signage or I don't know, certain things with their logo on. But whoever has incurred the spend, that's the entity or the person or the business that gets the relief, and that's how it would be split.
And it's worth sort of just following on that with landlord contributions. So there is an opportunity if a landlord does provide a capital contribution to a tenant, maybe to incentivize that tenant to sign up a lease, that spend that they've contributed, potentially the landlord can make a claim because ultimately they're the ones that have incurred that spend. So it might be towards the tenant fit out, but there could be a possible claim there for the landlord. And sometimes we do find that we get involved with landlord and tenant leases around who, if there is a contribution, what is that contribution towards? And ultimately, if it's towards sort of qualifying plant and machinery, who has the right? So there's an element there depending on what the landlord does in terms of incentivizing tenants and the tax treatments that follow. So are any capital allowances available for capitalized internal costs, so staff costs? Potentially. So if that staff cost is related maybe to a specific project, relating to, say, it might be an internal sort of project manager overseeing the refurbishment of an office, if we can associate that cost to the project, potentially there's a proportion of those costs that could qualify for capital allowances. So it's something that we would often pick up. And with most projects, there is an element of professional fees. So where there's potentially an architect or a quantity surveyor or a project manager that's overseeing the wider array of work, some of those costs can be allocated on a pro rata basis across sort of the analysis that we would normally undertake on that project. So similarly, staff or internal costs relating to the project would potentially qualify as well. So a couple of questions on sort of super allowance. Would a new machinery qualify? I think we covered that off. Yeah, as long as it sort of meets the criteria set out by the legislation for super deductions. Any new plant and machinery incurred between the time periods and contracted after 3rd of March should be qualifying, so shouldn't be an issue. If you're ordering an expensive piece of equipment and obliged to pay an upfront deposit, that's where it can be slightly nuanced and where there's deposits but not contracts signed. What I would say, we look at that on a case-by-case basis. It's very difficult to give a sort of a one answer fits all. So where equipment is being bought and there's specific arrangements, then potentially there could be a claim, but we would probably need to get into more detail around what exactly is happening.
One of them, can I mention, someone's asked, what did I mean by second-hand properties not having the super relief? So it's probably worth me mentioning that. What I meant by that is, generally speaking, when you're buying a property, it's normally second hand, and therefore the super allowances won't apply because it's not for second hand assets. But the reason this one's a bit funny is if you've bought it from the developer, to the developer, it's stock to them, it's WIP. So it's not like they owned it as a fixed asset on their accounts. It's cost of sales, and that's the only instance here you could get the super relief, is if it's a brand newly constructed property from a developer within that 2-year time limit.
Yeah. Next question I can see. So recently bought an office in a SAS, so effectively a pension scheme. On those, because the scheme isn't paying tax, that there wouldn't be on the purchase, or potentially if the SAS has incurred some refurbishment spend, they wouldn't be able to claim allowances. But if it was leased to a tenant, or to it could be a connected tenant, and that tenant is a trading company, a UK taxpayer, what you would want to make sure is that the tenant or the taxpayer is incurring the spend, and they will then be able to make the claim for capital allowances and the various sort of tax reliefs. Somebody runs a nursery school and looking to create an outside sort of classroom space to expand the environment. Would that qualify for super allowances? It depends, potentially. We would look at the structure of what is being built. There might be elements, some of the services, I guess the lighting, the heating, that could qualify for super allowances. Again, it just goes back to that criteria that has been set out, and making sure that the fact pattern matches. If for whatever reason we couldn't quite get the super deduction, and say if the works were contracted before the 3rd of March, there is still the annual investment allowance to help accelerate relief as well. So if it was that assets qualify for main pool and special rate, there are still other mechanisms to accelerate the tax savings. So it's something that we would look at as a whole if we were to carry out a review of a project like that.
It's probably a good example of how near the start I was saying there's different pools for different assets, where that one, it's likely that you're going to have a bit of main pool, a bit of special rate, some structures and buildings allowances, that kind of thing. So that would be one that I think we'd have to break down, and within the main pool and special rate pool, it might be that gets the super allowances depending on the dates.
Yeah. And someone's asked about electronic vehicle charging points. That's a really good one, actually. So I mentioned the enhanced capital allowancing being phased out. The one element that does remain is the vehicle charging points. So the cost of installing a charging point, you would get a full 100% deduction in year 1 for that. So that is one to mention, and a really good point. Solar panels, they would also qualify, not quite the accelerated relief that a charging point would receive, but that would be more special rate spend. Again, we would look at whether annual investment allowance can be used to help accelerate that relief, though. So it all depends on the profile of the business and the cost that business is incurring on an annual basis.
There's a good question that relates to the first slide I did as well, saying what's the difference between claiming depreciation on a van or seeking capital allowances on a van? But they're kind of independent. So your depreciation is what is going to show in your accounts and give you your the profit as per the accounts. But as I was saying, to work out what tax you owe, it's not a simple case of taking the profit from your accounts and timesing it by the corporation tax rate or the income tax rate. We have to do adjustments, and one of those adjustments is depreciation is disallowed. So whether you've claimed any depreciation or not, anything you have claimed is added back, and capital allowances are then deducted to work out your profits. So they're different. It's not a case of do I do one or the other.
Next question, we've got one around serviced accommodation. So we do a lot in the furnished holiday sort of letting space, FHLs. With FHLs, there are certain criteria that need to be met, and it's probably something I've repeated a few times, and that's an element that we would look at, and if they meet those criteria around how often or how many days of the year the accommodation is available for let, how many days it's let, the time it's let to certain people, is it sort of on a short-term or long-term basis. So there's certain rules around that, and if effectively your serviced accommodation meets that rule, then yeah, there would be a claim available. If you're starting a new business, there are certain elections and grace periods that are available. So it's something that we would definitely look at. And to be fair, given I think where we are with the pandemic, we've had a lot of clients who have acquired or converted maybe second homes into FHLs, and have therefore then made a number of claims on capital allowances as a result. So just looking through.
One of them is ask if there's a definition or like a list for assets that qualify for the super allowances, but I think that's what makes capital allowances so confusing or hard, is that there just is not a list of assets which are made, like all of these are main pool, all of these are special rate, all of these are, it just doesn't work like that, because it's done on a case-by-case basis. It depends on what that company's trade is, what the building's used for, what it was used for before the work. So it's really frustrating, and it's hard when we often have people ask, oh, can we have a list, so we can just go through it ourselves and know what goes into which pool. But yeah, it depends on a lot of factors.
We've got a really good question actually around R&D and the interaction between R&D and capital allowances. So Rebecca, I think, mentioned on that first slide research and development allowances. So where a business is performing a qualifying activity for R&D purposes, so where they are claiming potentially an R&D sort of credit, if there's a physical location where they're performing the R&D, so it could be that there is a certain manufacturer who has a certain number of offices that R&D is being performed, there's a lab, there's certain functions that are being performed that qualify for R&D. What we would do is look at the actual physical space, so the walls, the floor, the equipment actually as well that's being used, and that expenditure could potentially qualify for R&D capital allowances. And the really useful, or the really sort of, I guess, beneficial aspect of that review is around being able to sort of identify the wall, the structural elements. So something that would typically receive structure and building allowances at 3%. So the tax relief is received over 33.3 odd years. If we're able to claim R&D capital allowances on that spend, that's all received in year one. So it helps to accelerate that tax saving quite considerably. So it's always useful that if you are claiming R&D, and what we've begun to do within Azets is partner with our R&D specialist and to understand exactly what that process is, where the process is being performed physically, and then whether there's potentially capex incurred around that sort of area in terms of identifying sort of RDA allowances or research and development allowances. Question on land remediation relief and derelict land. It's around understanding how you can prove that land has been derelict. It's difficult to give an answer sort of over a training session. There's a number of sort of sense checks that we could perform depending on the case and the facts of the case, to understand whether we think there potentially could be an opportunity, and we would do that with the overlaying sort of the facts with the actual tax legislation. So it's very much a case-by-case process where we would look at what has been done historically, how the land or the buildings have been kept, who the prior owners have been. That often gives an indication once we establish that. And we have various mechanisms, tools, access to various software that helps us review and understand prior owners and prior property history. I think I'm just conscious of time. Try and wrap up a couple.
Should we do one last one maybe? Someone's asked about when it comes to leasing an asset and hiring an asset. So jump in if you want to add, but an asset bought under hire purchase, usually speaking, is fine and you can claim capital allowances. If something is bought like a finance lease, you don't get capital allowances, but it's a funny one with the hiring and leasing of assets. And again, it's one of the ones I would probably want to have a look at the leasing contract and read into the small details.
Yeah, as Rebecca says, sort of your classic hire purchase is more straightforward, and that's where capital allowances are available. We often look at the practical nature of what is being done, and then we can make a judgment from there. Leasing and finance leasing is a little bit more difficult, but the key, I guess, to highlight is if capital allowances aren't available, then potentially there is an allowable depreciation on the cost of that asset. So there would be maybe an alternative sort of way of receiving tax relief, and that's often received over the life of the lease. So we often get sort of involved in these sort of queries where clients are buying large amounts of equipment on a leasing or a financing contract. So again, yeah, very much case by case. Okay, I think that's everything. I think we've covered pretty much most of the questions. If there is anything that we've missed, or if questions come through at a later stage, we'll look to address those and contact you and provide some answers offline. Yeah, just our contact details again. So if there's anything that you think of post sort of this presentation and you wish you asked, feel free to get in touch. I think that's, from Rebecca and I, thank you very much. Hopefully that you found the presentation insightful. We're on hand to help. Thank you, and have a good good afternoon, weekend, and speak to you soon.
Thank you. Bye.